Welcome to this explainer. Okay, today we're unpacking an absolutely fascinating story of corporate transformation and, frankly, massive financial growth. We hear about the AI boom constantly, right? Chatbots, image generators, new software popping up literally every single day. But what actually powers all of that? I mean, it's not just code floating around in the ether. It requires massive, tangible, physical infrastructure. So today we're looking at HFCL Limited, a company that has strategically positioned itself right at the heart of this AI infrastructure boom. We're going to decode the incredible financial surge they're experiencing because of it.
You know, when there's a gold rush, the old saying goes that the people who make the real money are the ones selling the picks and shovels. Well, in the era of artificial intelligence and hyperscale cloud computing, what exactly are those picks and shovels? They're the optical fiber cables, the data center connectivity products, and the actual physical hardware that connects these massive server farms to the rest of the world. Basically, HFCL is building the physical internet that makes the whole AI revolution possible.
Okay, let's dive into this. Here's our roadmap for today. First, the AI infrastructure boom. Second, decoding HFCL's credit upgrade. Third, inside their financial surge. Fourth, building for the future. And finally, the risks and roadblocks.
Section 1. The AI infrastructure boom. Driven by AI data centers and 5G deployments, the global optical fiber industry is absolutely booming right now. Just consider this staggering figure for HFCL. As of March 31st, 2026, they reported a consolidated order book of 21,206 crore rupees. To put that into perspective, that's over 4 times their entire turnover for the previous financial year. No way, right? That is a massive pipeline of guaranteed work. And a huge chunk of this is a recent long-term overseas supply agreement worth over 10,000 crore rupees. That deal basically guarantees their manufacturing facilities will be running at over 50% capacity for the medium term.
But, it's not just about how much money is in the order book. It's about what kind of money it is. To really grasp HFCL's financial agility, we need to define 2 totally distinct parts of their business: turnkey operations versus product revenues. So, turnkey operations involve complex engineering and construction projects. The money is great, sure, but the billing is tied to slow milestones. It just takes a long time to get paid. Product revenues, on the other hand, come from selling physical goods, like those optical fiber cables. You make the cable, you ship the cable, you get paid. It's a much faster cash cycle. Keep this distinction in mind because it's literally the secret engine behind their recent success. This strategic shift towards faster product revenue hasn't just improved their daily cash flow, it's completely changed how the financial world views their stability.
Moving on to Section 2. Decoding the credit upgrade.
Now, credit rating agencies are notoriously strict. They look for any little sign of financial weakness. But recently, CareEdge Ratings upgraded HFCL's long-term bank facilities from a Care A+ to a Care A, and they revised their outlook from stable to positive. Their short-term facilities also got bumped up to Care A1. Translated out of financial jargon, this simply means the agency believes the company is highly stable, has strong revenue visibility, and is smartly managing its debt while executing a really massive scale-up. So why did they get this upgrade? Well, it comes down to a few core drivers. Obviously, there's the higher global demand for optical fiber, along with a successful capital infusion of over 1,100 crore rupees through equity and warrants. But what's really interesting here is that overall gearing ratio of 0.41x. Gearing basically measures a company's debt against its equity. A ratio of 0.41x means that despite taking on all these massive new orders and expanding manufacturing, they are not drowning in debt. Their balance sheet is remarkably healthy. Plus, as we just talked about, they're shifting their business model toward those faster-paying product lines, tightening up their cash flow. So the underlying structure is rock solid. But what does that actually look like when the quarter closes? That brings us to Section 3, inside the financial surge. The year-over-year growth here is just explosive. In the first quarter ending June 2025, consolidated revenue from operations sat at roughly 871 crore rupees. Fast forward exactly 1 year to the quarter ending June 2026, and that number rocketed to over 1,914 crore rupees. That means their revenue more than doubled in a single year. This isn't just some incremental growth, it's a structural leap, heavily driven by a huge increase in export orders and a laser focus on those higher margin products. And looking directly at the primary, unaudited financial results, the bottom line tells an even more dramatic story. Think about this. In the quarter ending June 2025, HFCL actually reported a consolidated net loss after tax of over 29 crore rupees.
But in the quarter ending June 2026, they posted a massive profit after tax of 245.64 crore rupees. That is an extraordinary swing from the red straight into deep profitability. It completely proves that their focus on optical fiber exports and operational efficiency is paying off in a huge way.
And the composition of their current order book proves that this profit surge is entirely by design. Remember our distinction between fast product revenue and slow turnkey revenue? Well, right now, approximately 69% of their 21,000 crore rupee order book is dedicated to products, with only 31% left for those turnkey and maintenance contracts. By leaning heavily into physical hardware, the picks and shovels we mentioned earlier, they're guaranteeing a much faster, more reliable stream of cash flow in the years to come.
All right, Section 4, Building for the Future.
So how exactly is HFCL future-proofing their operations? The details of a recent board approval highlight a major strategic move. They are building a brand new state-of-the-art manufacturing facility entirely dedicated to data center connectivity products. They're looking at this huge explosion of AI and hyperscale cloud computing and realizing, hey, the demand for next-generation optical connectivity is only going to accelerate from here. Let's break down the specs of this new facility real quick. They're pouring an estimated 215 crore rupees into the project, and they're aiming to manufacture 270,000 connectivity assemblies every single year. They expect the whole thing to be fully commissioned by September 2027, and this brilliantly illustrates their overarching strategy. They aren't just making generic cables anymore, they are specifically targeted on the high-growth, high-margin AI and hyperscale data center markets globally. Specifically, they'll be producing advanced components like miniature multi-fiber and super high-density multi-fiber termination assemblies. I know, it sounds highly technical, but just remember this. AI data centers process so much information simultaneously that traditional fiber optics just aren't enough anymore. They need super high-density connections to prevent bottlenecks. Every single time someone generates an AI video or queries a massive language model, that data has to travel through these exact types of physical high-density terminations.
Finally, Section 5, Risks and Roadblocks. Now, it's an incredibly optimistic picture, for sure, but we always have to look at the headwinds. According to the Care Edge Ratings report, HFCL's operations still remain highly working capital intensive. Their working capital cycle sits at an elevated 191 days. What that means is it takes an average of over 6 months from the moment they pay for raw materials to the moment they actually collect cash from their customers. That is a lot of money tied up in inventory and waiting on slow-paying debtors. Add to this the volatility of raw material prices, really intense global competition, and the execution risks of those remaining large government turnkey projects, and it's pretty clear the road ahead requires some serious, intense management. As the rating agency explicitly noted, their credit profile continues to be constrained by these very factors. So the crucial point is this. Yes, the top-line revenue is exploding, and the pivot to product manufacturing is driving massive profit margins. But scaling up physical, heavy-duty manufacturing across the globe is incredibly capital-intensive. HFCL will absolutely have to master their 191-day cash cycle if they want to smoothly execute that massive 21,000 crore rupee order book without hitting liquidity bumps along the way. Which leaves us with a final thought to consider. We spend so much time debating which software company is going to win the AI race, or which tech giant will create the absolute best algorithm. But as hyperscale data centers multiply across the globe to support all this computing demand, it raises a really fascinating question. Are the companies laying the literal groundwork, the hardware suppliers and fiber optic manufacturers like HFCL, the safest and ultimate winners of the AI revolution? It's the classic picks and shovels bet, playing out in real time. Thank you so much for joining me for this explainer, and definitely keep your eyes on the physical infrastructure of tomorrow.